Hey everyone, happy Thursday, June 1st. It's about 11:45 on the West Coast, and it's time for another market update. Luckily, I can tell you it's been a lot better this week since the last couple of weeks with everything going on in the markets. Starting with the debt ceiling drama getting resolved. As I'm sure you've seen on the news, that passed the House last night with bipartisan support, and now goes to the Senate. It sounds like it's all going to work out, just maybe some timing issues. There's still some debate whether or not it was good or bad for the country, but I could say, from the bond market standpoint, it wasn't a 100% home run, but it also was well received. So there was some spending. We never liked spending that's inflationary, but it wasn't crazy spending. So let's hope that, fingers crossed, that gets to the finish line. There's no snags. The next thing, going back to last Friday, we got April PCE inflation numbers, and those came in a lot hotter than expected. So plus 0.4, both on the headline and the core. And that was really, from energy and used cars. Like we were worried about, we got a little of a hint from the CPI data. We knew that gas prices, oil prices had spiked during that month. We knew that used cars had spiked during that month, and that held true. The pink and blue spikes are the actual data. These trending lines, though, as we can see, that headline rate has been coming down a lot more consistently. Where this core rate, the blue one, dotted one, that's been a lot more sticky and a lot more stubborn. And we know that the Fed's paying really close attention to that. And we'll get into some reasons why we know that, we're confident that it will continue to come down. But so far as, like I said, been very stubborn. Next thing we got March appreciation for Case-Shiller and FHA data. And they keep going up. That's good to see. Going here, so as you can see, Case-Shiller was up 0.4 for March. FHFA was up 0.6. Year over year, Case-Shiller was up 0.6. FHFA is up 3.6. And from the peak, Case-Shiller is just down 2.3%. The peak was June of 2022. And FHFA is up actually from the peak, 0.7%. And keep in mind the difference between these two is Case-Shiller includes cash deals and includes jumbo deals. So usually a little bit more expensive homes than the FHFA. And then another thing to keep in mind, this year-over-year number for Case-Shiller is going to turn negative in the next couple months. Not quite sure when, but this will turn negative year-over-year because we're replacing, the way year-over-year numbers work, we're replacing high data from last year. The housing media is going to, go freak out about that and talk about the sky is falling. Just ignore that. Just know that that number will turn positive again. And it's just the way they kind of look at this, they do this data. And the other thing, besides Case-Shiller and FHFA, CoreLogic, Black Knight, and Zillow, all over the last few months, we can see these all trending up. So there was a pricing correction for sure, but pricing crash, no. Appreciation now, anybody that was on the sidelines, nationally saying, I want to wait for prices to come down, we're heading the opposite direction now. Prices have been consistently going up across the board according to all these different metrics. The next thing we got, it's jobs week this week. Lots of jobs data, starting with the JOLTS, the job openings report. That came in at 10.1 million, up from 9.7 million last month, but down from 12 million peak. Still a lot of jobs. That wasn't the best data to see that go up when we got that yesterday. And then we got ADP came in at 278. That's wrong, to 278,000. Which was only expected to be about 170. Which is a big gain. But we saw that there was 203,000 jobs created in leisure and hospitality. And like we've talked about, leisure and hospitality has been leading a lot of these job gains across the board, but it should be running out of steam. In April of 2019, there were 16.2 million jobs in this country that are leisure and hospitality. After this report, after this gain, we're up to 16.5. So not only have we gained all those jobs back, we've actually added 300,000 leisure and hospitality jobs on top of that. So at some point, that industry is going to run out of jobs to fill, and that's also a little bit seasonal too. Besides that, so this ADP number was a big number. So far today, the market has kind of shrugged it off, and a lot of that has to do with wage inflation. Wage inflation in the report showed it being a little down, which is good. We don't. Not me personally, but the markets, the Fed doesn't want people making their wages going up too fast. And then the challenger job cuts, which kind of looks at corporate layoffs, that was at plus 80,000 layoffs this last month, up from 66,000 the previous month, or 64,000, I believe, which was about a 20% increase. So, that one, that's a big number. So we got to keep an eye on that, and keep an eye on all this job data, which goes into job claims. Initial jobs claims was today. As far as people filing for unemployment for the first time, that was expected to be 235,000. There was 232,000, so slightly under that. There's still 1.8 million about continuing claims, so people that lost their jobs and can't find a new job. So these still are elevated numbers. Not that I want more people to lose their jobs. If these numbers were higher, I'd feel a little more secure with what the Fed's going to do. But hopefully they're looking at this forward data, looking at these continuing claims. The next thing we got was purchase apps were down 3% last week, down 31% year over year. Bad couple weeks for rates. We know that reflects in apps. So with a pretty good week this week, this will probably be a positive number next week. And the miscellaneous stuff, the FDIC deposits are down 2.5% year to date, which since they've been tracking this metric for 39 years, that's the biggest drop in the first quarter. So that is something that goes back to what we talked about last week about people taking their money out of banks and putting it elsewhere, which has been hurting the bond market. And then Fed speakers, we had a Fed speaker say yesterday that they hope they keep hiking. We had a couple yesterday as well, and today say they don't favor a pause, but a skip, meaning, not necessarily stopping hiking, but stopping at least for this next meeting coming up in June, which, either way, a skip or a pause, I'm all in favor for. But these Fed people are going to continue to talk, so it definitely affects the market, but it's nice to see some of them starting to say things like that as far as skipping the next hike. And then the average 30-year conventional was down from 7.12 to 6.85%. Still way too high, but it's nice to see it get underneath that 7% rate. Hopefully this next week continues to go better and we get closer to that 6.5 at least. Important dates. Tomorrow we got BLS jobs report. This is really important after all these other job ones this week. Really important to keep an eye on this. What number this comes in as is probably going to play a pretty big factor in what the Fed does coming up on June 14th. Depending on what you see in the news tomorrow, that's going to have an effect on mortgage rates. And then CPI inflation is coming up June 13th, the day before the Fed makes their next decision. And something, one reason why we feel confident we've talked about is, 43% of that core CPI number is shelter costs. And as we know across the country, shelter costs have been coming down forever now. They're down to 0.9. This last in the CPI is this number right here. This very last CPI last month finally came down from 8.2 to 8.1. So we finally peaked and started to crest, and now hopefully we're going to start seeing that data, go positively. And the other thing that we feel pretty positive about as far as that upcoming CPI data is that we know gas prices, oil prices had spiked in the previous month at $80 a barrel or so, and right now we're about $70 a barrel, I believe, or we are down to $70 a barrel this month. So that will show up in the energy cost. We know that used cars, which were plus 4.7, I believe, are only about, according to certain metrics, are about only plus about 0.8 right now, which is less inflationary, which would be good for us. And in fact, if you've seen something adjust, it might come in negative, which would be actually deflationary, and we'd love to see that. So there's a couple things that we know that are going to start turning around as far as this data that should make that CPI number lower. We get a lower CPI number heading in that Fed meeting. That's going to be really important. If we get a higher CPI number heading that Fed meeting, probably gonna hike. Right now, the markets are looking at a 75% chance they're going to pause and a 25% chance they're going to hike. So, we're going to have to take a look at that thing and see how things go. Fingers crossed that not that a lot of people lose their jobs, but a BLS jobs report comes out in our favor tomorrow. And if anybody needs anything at all, please do not hesitate to reach out. Have a great day, everybody.